Okay, so you want to own a golf course. Buy a good stretch of rolling countryside, lay out 18 holes, build a clubhouse with a proper bar and a view over the 18th green, and collect membership subscriptions from people happy to pay for the privilege of playing around most weekends. That is the plan in your head. And golf carries a genuine, deep tradition in Britain, the home of the game. A business that feels like it should be as durable and as well-loved as any institution in the country. Walk past a well-kept course on a sunny Saturday morning. Members heading out in groups of 4, the car park full, the clubhouse bar doing steady trade after the round. And you think this must be one of the more pleasant, more reliably profitable businesses in the whole of British leisure. Here is the problem. You are looking at the one sunny Saturday that lies to you the most. The truth is that a British golf course is not really a sporting or leisure business in the simple sense. It is a subscription business, built on exactly the same fixed cost, uncertain attendance dynamics explored in the gym breakdown elsewhere on this channel. Except sitting on top of considerably more land than almost any other business this channel has covered. And that land itself has quietly become worth more to a great many owners than the golf club actually operating on top of it. Once you understand both of those pressures together, everything about why so many genuinely well-loved British golf clubs have closed their gates for good in recent years starts to make sense. Let us start with what it actually costs to build or acquire a golf course. Because the land requirement alone puts this business in a genuinely different capital category than almost anything else covered on this channel. There is not one type of golf club in Britain. There are several, and each one is really a different business, wearing the same tartan trousers. At one end, you have the traditional member-owned club, structured as a members' association or a company limited by guarantee, where the members themselves collectively own the course and the clubhouse. And the club's finances exist essentially to cover costs rather than to generate profit for any individual owner. A genuinely different financial structure from every other business explored on this channel. Above and alongside that sits the proprietary or commercial club, privately owned, often by an individual, a family, or an investment group, run explicitly as a profit-seeking business charging membership fees and green fees to generate a genuine return for its owner. Above that, the resort-style golf destination, combining a course with a hotel, spa, and considerable additional leisure facilities, capturing revenue well beyond golf itself. And then there is the pay-and-play or municipal course, charging per round rather than through membership subscription at all. Typically operating on somewhat thinner per-visit margins, but without the membership churn risk the subscription model carries. Each of these is a different bet on the same underlying question. Are you building a business around the loyalty and predictable recurring revenue of a membership base, or around capturing casual, one-off demand from golfers without any ongoing commitment to your specific course at all? Now here is where the naive mental model starts to break down. You think the expensive part of this business is the clubhouse, the pro shop, the visible bits members and visitors actually see. It is not, or at least it is only a modest fraction of the real capital picture. Because a proper 18-hole golf course typically requires somewhere between 100 and 150 acres of land. And depending on location, that land alone can represent a genuinely enormous capital outlay before a single fairway has even been shaped, particularly anywhere within reasonable reach of a British town or city, where land carries meaningful development value rather than simple agricultural pricing. Building the course itself, shaping fairways and greens, installing a proper drainage and irrigation system capable of keeping greens playable through a genuinely unpredictable British climate, and constructing a clubhouse to a standard members expect typically requires several £1 million in total. A capital commitment considerably closer to the scale of the vineyard and seaside hotel breakdowns explored elsewhere on this channel than to almost any smaller local business this channel has otherwise covered. Now, the ongoing maintenance cost. And this is where the genuinely distinctive, genuinely relentless nature of this specific business becomes clear. A golf course does not simply sit there once built. It requires continuous, skilled maintenance, regardless of how many members actually play it on any given day. Greenkeeping staff mowing fairways, tending greens, managing irrigation, and maintaining bunkers and rough on a schedule dictated by the grass and the weather itself, not by how busy the course happens to be. A mid-sized club typically employs a genuinely significant greenkeeping team, and the specialist equipment required, mowers, aerators, irrigation systems, represents a considerable ongoing capital and maintenance expense in its own right. This cost runs almost identically, whether the course is fully booked with members playing every single day or sitting largely empty through a quiet, wet stretch of winter. Precisely the same fixed cost against a variable attendance mismatch explored in the gym breakdown elsewhere on this channel. Except here, the fixed cost of maintaining the actual physical product, over 100 acres of manicured grass, is considerably higher and considerably less avoidable than the fixed cost of simply keeping a gym floor's lights on. Now, weather, and this hits British golf with particular, genuine severity, given the climate the sport is played in. Heavy, sustained rain can render a course unplayable for days at a time. Waterlogged fairways and greens simply unable to support play without risking serious, lasting damage to the turf itself. And British winters bring a genuinely significant seasonal dip in playable days and in member attendance more broadly, shorter daylight hours and colder, wetter conditions discouraging even committed members from playing as regularly as they might through a good British summer. This creates a genuine seasonal revenue pattern, echoing the seaside hotel breakdown explored elsewhere on this channel. A club earning a meaningfully larger share of its green fee and visitor revenue across the warmer months, while its core fixed costs, greenkeeping staff, clubhouse overhead, continue at close to the same level throughout the entire year, regardless of season. Now, the membership and churn economics, and this is genuinely where the gym breakdown's core insight applies almost directly. Golf club membership, much like gym membership, depends heavily on a base of members who pay their annual subscription reliably. And industry research and club-level data have consistently identified a meaningful share of golf club members as playing considerably less frequently than their subscription cost might suggest a rationale, purely usage-driven customer would choose. Members who joined with genuine enthusiasm, perhaps during a particularly good summer or after taking up the game newly, whose actual playing frequency then quietly declines over subsequent years while their subscription continues, generating exactly the same kind of low marginal cost, high margin revenue explored in the gym breakdown. A member who plays rarely costs the club almost nothing in actual courseware or clubhouse resource use, while their subscription revenue continues arriving reliably regardless. But golf clubs face a genuinely more severe version of the demographic pressure explored in the small-town bar and country church breakdowns elsewhere on this channel, because British golf club membership has skewed, for a considerable and well-documented stretch of recent decades, toward an older demographic, and participation survey data has repeatedly identified a genuine, sustained challenge attracting and retaining younger members and junior players, a demographic pattern that, left unaddressed, directly threatens a club's membership base over the coming years as its existing, older membership base gradually declines through natural attrition without a comparably sized younger cohort ready to replace it. Now we get to the part of this business that actually explains everything else. And it is the land value question, a mechanism this channel has explored before in the roadside motel breakdown, but which applies here with even greater force given the sheer scale of land a golf course actually occupies. 100 or more acres of well-maintained, well-drained land sitting on the edge of a British town or city, precisely where a considerable number of golf courses happen to be located, having often been built decades or even a century ago on what was then genuinely rural land at the edge of a considerably smaller town, can represent an enormous potential value for residential or commercial development. A value that, in a meaningful and well-documented number of cases across the country in recent years, has come to exceed what the land could ever realistically generate, continuing to operate as a golf club. Britain's persistent housing shortage and the resulting pressure to release land for new residential development has made golf course land a genuinely attractive target for developers specifically, and a number of clubs facing declining membership, rising maintenance costs, or simply an owner recognizing the land's alternative value, have closed in recent years specifically to be sold for housing development, a pattern that echoes precisely the land banking dynamic explored in the roadside motel breakdown. Except here, the underlying business, unlike a genuinely obsolete bypassed motel, may well have still been a functioning, even reasonably successful golf club right up until the moment its land value simply became too significant to ignore. Now, planning permission, and this cuts in a genuinely interesting, double-edged direction for this specific industry. On one hand, the same green belt and planning restrictions that make building an entirely new golf course from scratch on undeveloped land considerably more difficult in modern Britain than it would have been decades ago, also protect a great many existing courses from casual, opportunistic redevelopment. A genuine barrier a developer has to clear before an existing course's land can actually be converted to housing. On the other hand, this same planning restriction environment means the small number of existing courses sitting within reach of genuine planning permission for redevelopment carry a disproportionately concentrated version of this land value pressure. Because the scarcity of realistically developable land near any given town makes an existing golf course, once it clears the planning hurdle, an especially valuable target precisely because so few comparable alternative sites exist. Now, the diversification response a number of clubs have pursued specifically to build revenue less dependent on core membership subscriptions alone, echoing the diversification strategies explored in the small-town bar and small-town hardware store breakdowns elsewhere on this channel. Clubhouse weddings and corporate events have become a genuinely significant secondary revenue stream for a considerable number of British clubs. Monetizing the clubhouse and its grounds on days and evenings, the golf course itself generates little direct revenue, and driving ranges and practice facilities requiring considerably less land and considerably less maintenance cost than a full 18-hole course have allowed some clubs to capture a broader, more casual customer base beyond their core subscribing membership. A customer willing to pay for an hour hitting balls without ever committing to a full membership at all. There is a structural choice sitting underneath all of this worth understanding. And it is the decision between the traditional member-owned governance model and a shift toward proprietary, investor-backed ownership. A member-owned club, governed by its own membership through an elected committee, can find major capital decisions, a significant irrigation system upgrade, a clubhouse renovation, genuinely difficult to push through quickly, because those decisions typically require broad membership buy-in and, frequently, a capital contribution or a fee increase. The existing membership has to collectively approve. A proprietary club, by contrast, can make capital investment decisions considerably faster, but exists explicitly to generate a return for its owner, meaning member interests and owner interests are not always perfectly aligned in the way a genuinely member-owned club's governance structure, at least formally, guarantees. A considerable number of traditional member-owned clubs facing genuine financial strain in recent years have converted to proprietary ownership specifically to access the capital and the faster decision-making a private owner can provide. A genuine trade-off between membership control and financial resilience that echoes in its own way. The franchise versus independent ownership tension explored across several other breakdowns on this channel. There is also a wrinkle worth understanding around environmental and water use regulation, a genuinely growing cost pressure for this specific industry. Maintaining golf-quality turf, particularly through drier summer stretches, requires meaningful irrigation and increasingly strict water abstraction regulation and rising water costs. Alongside genuine, growing public and regulatory attention to water use during periods of drought or water stress, have added real, ongoing compliance cost and operational constraint to golf course maintenance that did not exist to the same degree in earlier decades. A cost pressure that, similar to several other regulatory compliance costs explored across this channel, tends to burden smaller, less capitalized clubs proportionally more heavily than larger, better resourced operations able to invest in more efficient, more modern irrigation infrastructure. Now, here is where the financial fragility becomes just as important as a busy Saturday morning tee sheet looks. Why do so many golf clubs, even ones with a genuinely loyal, genuinely long-standing membership, still describe operating on remarkably thin margins or facing genuine uncertainty about their long-term viability? The pattern is structural. The course's core maintenance cost runs at close to the same level regardless of how many members actually play on any given day. Membership churn and an aging demographic base mean a meaningful share of subscription revenue depends on members whose actual playing frequency and long-term retention cannot be taken for granted. British weather concentrates a considerable share of usable playing days into a genuinely narrow seasonal window. And the underlying land itself, precisely because a golf course requires so much of it, increasingly carries an alternative value that, in a meaningful and growing number of documented cases, has come to exceed what the club could ever realistically generate, continuing to operate as a golf course at all. So how does a golf course actually make money in plain mechanical terms once you strip away the pleasant Saturday morning image? The core engine is membership subscription revenue, plus green fees from visiting non-members, plus clubhouse food and beverage revenue, and any diversified income from events or driving range, minus greenkeeping staff and equipment costs that run at close to the same level year-round, regardless of actual course usage, minus clubhouse overhead, minus irrigation and increasingly costly water use, minus the debt service on whatever capital was originally borrowed to build or acquire the course and clubhouse in the first place. A mid-sized club with 400 members paying an average subscription of £1,200 a year generates roughly £480,000 in membership revenue alone, against which greenkeeping and course maintenance can easily consume £200,000 or more. With clubhouse staffing, utilities, and ongoing capital maintenance consuming a further meaningful share, leaving a genuinely modest operating margin that provides little cushion against a membership decline, a run of genuinely poor weather, or significant unplanned repair to course drainage or irrigation infrastructure. Now let us put all of this together and look at what actually happens over the life of a British golf club's ownership journey, because this is where the two very different versions of this story reveal themselves. In the optimistic scenario, a club has built a genuinely stable, reasonably diversified membership base, including a meaningful share of younger and junior players, to sustain the club well beyond its current membership's own natural lifespan, has diversified its revenue through weddings, events, and a driving range that reduce its dependence on core subscription income alone, and sits on land without the kind of acute, nearby development pressure that might otherwise tempt an owner or a membership vote toward selling the course entirely. Under those conditions, a golf club can remain a genuinely stable, well-loved community institution for decades to come, much like the small-town institutions explored elsewhere on this channel. In the more difficult, increasingly common scenario, a club faces a genuinely aging membership base without sufficient younger players joining to replace it, absorbs the same largely fixed maintenance costs regardless of that declining attendance, and sits on land close enough to a town facing genuine housing pressure that the value of that land, sold for development, eventually exceeds anything the club could realistically continue generating as a going concern. A combination of pressures that has led a genuinely significant number of British golf clubs to close in recent years. Not because members stopped loving the game, but because the underlying economics of maintaining over 100 acres of manicured grass against a subscription base that could not always be relied upon to keep pace eventually stopped adding up. So if you do decide to own a golf course in Britain, remember the one thing that actually determines whether it survives across the decades. It was never really about how full the car park looks on a sunny Saturday morning. It is about whether your membership base can keep pace with the largely fixed, weather-exposed cost of maintaining the ground beneath it, and whether the land that course sits on ever becomes worth more to somebody else than it has ever been worth to you continuing to run it as a golf club at all. If this kind of breakdown helps you see a business differently, that is exactly what this channel is built around. Subscribe to Money Framework British for more deep dives into how everyday businesses really make their money behind the scenes. And turn on notifications so you never miss the next one.